Well, everyone in the US may not necessarily be happy about the election results, but we can definitely say that the equity markets are. We've seen quite the rally over the last couple of days. We're recording this 2 days post-election, and the equity market rallied over 2.5% the day following the election. And so the market is certainly happy with a Trump victory and what was more of a kind of red wave scenario than was initially anticipated.
There are a number of reasons that the equity markets are booming off of this, but predominantly we're going to talk about the prospects of lower regulation. You can finally have certain clarity around other things and, just de-risks the whole market a whole lot, and then along with that is lower tax rates for corporations, talking 19% or 15% for domestic producers. And, all of this, lots of things going on, but those being a couple of the biggest ones and really driving the crazy performance we've seen in the last couple of days.
Yeah, I think what I want to talk about today is really the policy implications that are going to impact markets. Of course, there's a lot of more social leaning policy that's not relevant to our world necessarily. So I want to kind of dive into some of the specific things, regulation, other facets of the forthcoming Trump administration that's going to impact our world, that's going to impact financial markets, that's going to impact investments. And so I think it'd be great for us to walk through that a little bit today.
Yeah, exactly. And so taking it from the top, kind of like I mentioned, you have your IPO M&A activity that's going on right now, which is a really big one. Lenient and the FTC have not been the largest proponents of mergers and acquisitions. We've seen very little IPO activity over the past few years. Lenient just blocked a potential buyout of Coach brand by Michael Kors. And so, you're talking about luxury handbags, which is usually far outside of what the FTC is concerned with, because they're concerned with anti-competitive behavior and monopolistic market positioning. And so usually when it's luxuries, that's far and away from what people are really looking to the FTC for. And so, that's just very indicative of what companies have faced over the past few years and something that will likely be changing under this Trump administration.
Yeah, I think the whole theme of deregulation is going to be big here. I mean, Trump has been pushing this, working with Elon Musk, talking about really restructuring the government and these three-letter entities like the FTC, like the DOJ, because they have become a burden to corporate America. And the goal is for these agencies is to keep them, in a position where it's beneficial to the consumer at the end of the day. But it's kind of turned into some degree of overreach. Your example of luxury handbags is right on that. And then you also have situations like the Frontier Airlines and Spirit Airlines merger that got blocked. You're talking about two airlines that are essentially in position to go bankrupt that via a merger would be able to stay alive. Well, when that gets blocked, you aren't saving the consumer by preventing, a lack of competition. What you're preventing is companies from, being able to survive. And so a budget airline, combined via Frontier and Spirit would create benefits for the consumer. And I think there's just this degree of overreach in the government from that perspective. And so I think what you and I are looking at from this administration is just broader deregulation. Of course, they've talked a lot about cutting budgets, about really balancing the deficit. And that's something that we'll definitely have to keep an eye on over the course of the administration. But it's going to be really interesting just to see the degree of how much deregulation and how much, budget restriction will be possible under this administration.
And along with that broader theme of deregulation is, this uptick in M&A activity, IPO activity that's going to help the big banks as well as, the individual companies that you mentioned that are taking part in this that can potentially be saved or, turn into a profitable business. But also the investment banks that are making these deals happen are going to be big beneficiaries from all of this. And then moving on to, like I mentioned earlier, lower tax rates for corporations. Corporations are different from individuals in a lot of ways. Legally, we try to treat them as people, the corporate personhood idea, but they spend money and are like consumers differently than people are. You don't really see businesses with a lot of retained earnings, a lot of savings. They're not investing for their future in equity markets and savings accounts. Their investments take the form of, their equity markets would be repurchases of their own shares. So that's returning money to shareholders. Same with dividends, or they're spending that on additional headcount, on M&A, on research and development, reinvesting in economic activities. All of this drives further economic activity or drives additional income taxes. So by lowering the corporate tax rate, you can really spur a lot more economic growth from the corporation level. And then you still tax it at the individual level because it all trickles down to a consumer somewhere.
Right. And yeah, Trump is really targeting that 19% corporate tax rate, 15% for companies that are making their goods within the United States. It'd be interesting to see how that exactly plays out over the course of the administration. But right now we're sitting at 21%. So you're talking about a pretty modest decrease. I mean, under the first Trump administration, that corporate tax rate was knocked from 35% to 21%, which was obviously very substantial. And then that was kept by the Biden administration. But we'll see just how far further those corporate taxes get reduced under this new administration.
And for reference, 21%, we're still kind of at the high end of most developed economies, right?
That's right. Yeah. And I think that's the interesting part to make too, is that, we don't necessarily have a low corporate tax rate, but what we saw under a 35% and, potentially higher corporate tax rate before was that companies were re-domiciling in other countries. They were looking to move operations outside of the US. So you're either skirting high corporate taxes by moving elsewhere, or, by lowering corporate taxes, you're incentivizing those businesses to come back, to set up shop within the United States and to pay those taxes here. So it's kind of the win-win between, more return to shareholders, more people employed, more CapEx, more economic activity, and retaining a lot of that tax revenue that you wouldn't have otherwise.
And so on that theme of getting companies to re-domicile in the US, which is a big theme of the Trump presidency, is tariffs, which, if you'll walk us through that, very similar goals involved and, different way of coming about it.
Yeah, so Trump definitely has a love for tariffs. He's said that is the most beautiful word in the dictionary, which might be going a little bit far, but he's certainly looking to implement these in his administration further so than he did under the last admin. Many of the tariffs that he put on China in his administration were kept by the Biden administration because they saw that it was good for U.S. companies. Well, I think Trump is looking to go a little bit further. And so that means further taxing China, trying to bring a lot of those manufacturing jobs back to the United States. And I think the big takeaway from this is it's not necessarily, or we doubt that it's going to look like tariffs across the board, just tariff everything. Things that we are currently producing in the US, it's going to make sense for the US to put tariffs on because that, reinforces production and employment within the United States. Whereas if we're not making a product within the US, it doesn't make sense to tariff it because we're going to have to import it anyway. And I think this is also going to be used as more of a negotiation standpoint in order to create international fairness than just to, generate tax revenue, because Trump is a negotiator and what he wants is, a fair playing field for US corporations and US manufacturers and their employees. And so by, forcing other countries to at least lower their tariffs on the United States down to kind of what we have them at, is what I think a lot of these tariffs are going to be used for.
Yeah, there's a reason you don't see any Ford or Chevy trucks driving around the streets of Europe. Not because it's so necessarily so urban, because they do have a lot of rural area in their own trucks that they use, but because they have such a big auto industry that they've kept secure via tariffs on us. And so it's kind of that reciprocal nature of, getting them to potentially drop that by instituting the same thing against them. I mean, we have a different but fledgling automotive industry here in the US, in 08, 09 is really struggling, but come back with, you have your Ford, Chevys, and now Tesla, one of the, biggest automakers in the world now, that are really kind of building that back out and making us more competitive on the global scale.
Definitely. And I think we've kind of covered probably the main policy things that are going to impact markets and kind of the broader economic situation. But I'd love to go asset class by asset class and talk about what the implications are going to be. We'll dive into equity a little bit further. But first, we've already seen quite a move in yields. I'd love to kind of cover what we're looking at as far as fixed income goes.
Yeah. So leading up to the election, yields were up. They were going up. They've been creeping up for a while. And then the day after the election, they spiked to a degree that I haven't seen maybe ever, but certainly a very large degree upwards. And so that can be explained by a number of things. They're kind of differing stories, but all things that push yields up, based on, like you said, we'll talk about it later, but the equity market's reaction of that also spiking is the but the movement from these safe haven bonds into equities, which results in a lot of bonds selling, pushing yields up, as well as the continued concern around the US government budget deficit. And as you've probably seen, a lot of media outlets have been reporting that, the impacts of Trump's economic plan, depends on how you come to these numbers, but for a lot of people, they're looking at potentially a much more spendy administration under Donald Trump. We'll see if that plays out or not, because I think the one thing he does have going for him is being surrounded by people in the Republican Party who are a little more traditionally fiscally conscious. So hopefully that'll balance out a lot of these, other investment things that he wants to do. But deficits are bad for bonds. So, if facing a potential downgrade in credit rating, if we continue on the current trajectory or an accelerated trajectory of deficit spending, then, that could really hurt bonds. So there's also that concern of additional deficit spending, sell bonds, get out of that, move that elsewhere.
You're exactly right. I think the market's going to pay way closer attention to the fiscal situation over the coming years, this administration and likely the next, because it wasn't really until this last year, maybe parts of 2023, when markets really started seriously talking about, hey, look at the government debt. Is this sustainable? And at what point, does U.S. debt get downgraded? And that is a concern for markets, and it's impacting yields in a way that we haven't seen before. Typically, it's your central bank activity. In the case of the United States, the Federal Reserve and the interest rate levels. But as of late, it's become a lot more about that fiscal situation, which is going to be interesting. Now, I think when it comes to the Fed, and we'll continue to talk about the Fed on future podcasts as we always do. But I think their calculus stays pretty much the same as far as their rate cut agenda. They're going to continue to decrease rates. We're recording this on the day of a Fed rate action, which we expect them to cut 25 basis points. And I think that they're going to stay more or less the same, but the growth situation in the United States and whether, tariffs or other tax cutting leads to maybe sustained inflation above their target level will be interesting to watch as far as how are they going to react to the growth environment in the United States. On the positive, it's probably going to be good for the job market, but there is a negative case, possibility where you have inflation sustained because of tariffs, because of higher growth, just leading to more economic activity, dollar flow, and potentially some sustained inflation.
Yeah. So we've already seen huge moves in foreign exchange, and, similar to that, like another foreign currency is cryptocurrency. It's something that we're watching right now because especially as those yields come down, non-yielding assets like crypto will probably benefit from this. It's been really hard for them to compete with, other equities or other options out there when rates are so high and they're not yielding anything. So hopefully, see some of that growth. I think it's probably about time to get another crypto podcast and delve into that a bit deeper. But that's certainly an area of the market that we're looking at. And then additionally, like, let's get into the equities a little bit further. We've talked about fixed income, Forex, crypto, but the meat and the potatoes of the situation, equity markets, they've ripped over the past couple of days. And the growth implications are different under this administration. Do you want to walk us through that a little bit?
Yeah, and I'd love to go sector by sector on this because that's how you and I and how we at Beck Capital Management really think about markets. Starting at that 30,000 foot view, we already kind of talked about broad economic impact, but now diving into the sectors, the industries that are going to benefit or be harmed by potential policy. And what is going to come first and foremost in most people's thoughts whenever they think about the Trump administration is energy policy. And he's a drill, baby, drill kind of guy. And so I think following what the deregulation of the energy industry will look like is going to be really interesting. We expect more oil flow, which is likely to lead to, at first a benefit as far as volume production for those oil producers. But we do expect that to drive down the price of oil, which in the end may hurt those upstream suppliers. Well, if we're incentivizing the use of oil, then we think that those midstream producers, not producers, but transporters, the midstream companies, as they transport more oil, more gas, they're getting more flow through, and that should help their earnings. And then I think you also want to talk about, the LNG shipping projects. So those have been kind of a lockdown under the Biden admin over the last, almost a year at this point. And so those companies that do a lot of LNG shipping is going to be interesting to see how those ramp back up. We don't have the same kind of international market for natural gas as we do for oil because it is harder to transport. But now with liquid LNG or liquid natural gas shipping, it's becoming more of an international market. And so the more that that's going on, the closer you'll see prices in, say, Asia to the United States. Gas is extremely cheap here, but it's relatively expensive over there just because of different production levels. But the more and more you can ship those, the more and more tight those markets are going to be. And then finally, I think clean energy is something to watch as well. There have been a lot of government subsidies for clean energy projects over the last 4 years. We expect those to wind down to some extent. Although we do have to note that, Elon's going to be involved in this administration. He's a clean energy guy, loves batteries, loves solar. So that might help temper some of the, Trump policies from his prior administration as far as the green energy subsidies and things like that go.
Yeah, that makes a lot of sense. And, just continuing on, looking at the industrials materials sector, to your point about energy, there's been a lot of talk about energy infrastructure and power generation. Given the data center boom, those require tons of electricity, something that the grid's not able to handle currently and isn't really set up to handle in the future because, power demand generally grows just as a function of population growth, not very quickly, not huge variations, and companies can have these long time horizon plans to address that. Well, what's different right now is that it's happening now. It's sudden. It's a very distinct uplift in power requirements. And so as those power generation units get brought online and built out, that's a lot of R&D and a lot of just economic activity in the materials and industrial space, as well as we were talking about earlier, reduction in corporate tax rates allows companies to invest more in that those CapEx projects that they might want to do that, in the current day frequently involve large amounts of, stuff, whether it's building a new data center, building, new power generation, whatever you're looking at nowadays, especially, there's a lot of that going on in those segments.
Yeah, I agree. I think it's going to be interesting to see, especially infrastructure spending as well when it comes to industrials and materials, just because we have infrastructure in the United States that needs to get revamped. Every administration talks about it. So, and I think that the Trump administration will be a little bit heavier on the infrastructure spending. So it'll be interesting to see, how that flows through to those industrials and materials companies. When it comes to consumer discretionary, I think it'll be interesting because we were talking about tariffs, and that might impact especially goods produced in China. A lot of our kind of normal consumer goods get produced over there. And so if there are massive tariffs on China, there's potential for some of that stuff to get more expensive before production can really ramp up in the United States. But then again, Trump's administration is looking to be a little bit more favorable from a tax perspective as well. So that means more take-home dollars for workers. I mean, we've talked about no tax on tips, no tax on overtime, and just generally favorable tax policy. That's going to look very similar to what it does right now under the Tax Cuts and Jobs Act from his first administration. That's likely to flow through and get continued under the next administration. And so we think that the tax situation will look relatively the same, maybe slightly better for U.S. workers. And so that's more take-home dollars, more spending in those discretionary areas, which is good. I think technology is interesting. I mean, we talked about earlier about regulatory oversight and, M&A crackdown. I think that's going to loosen up, and a lot of that is on tech companies. And so that should help them operate, be able to acquire new companies. Like you said, more IPOs. You'll have some of these budding tech companies go to market via those initial public offerings. And so I think that bodes well for that sector. I think an interesting one is healthcare. That one's probably going to be a little bit mixed as far as the reaction. Both Democrats and Republicans have been big on reducing drug costs. And so I think there's going to be pressure on big pharma over Trump's next administration. But there's still the mega trend of this U.S. aging population that needs more and more treatment. And so we're still looking at, hospitals, medical devices, managed care, all of these things still performing pretty well without a lot of really much government oversight that we anticipate.
Yeah. And so you mentioned M&A in tech space. As I mentioned earlier, that's really going to help out big banks, financials sector. Additionally, some clarification and regulation is going to be really great for that sector specifically. You've had Basel III sitting out here, kind of ever changing for years now, I guess. And so, that's been a give and take back and forth between the banks and the governments. And so, maybe achieving some clarity around that will really help the financials along with that uptick in M&A IPO activity as well. And then revisiting industrials briefly, one thing that I think is worth adding is that what falls under industrials are your defense companies. And we've been providing so many missiles and rockets and defense units and everything we have to Israel and Ukraine for the past few years. And I think Donald Trump's going to be probably more inclined to rebuild our domestic stockpiles of that and just push more investment dollars that direction generally. I mean, usually Republicans are the defense spenders of, presidents. And so as those dollars get pushed back into our domestic manufacturing of those goods, that's going to also help the industrial sector because that's where the defense companies lie.
Exactly. And I think we've done a good job diving into these individual sectors. They're all going to be impacted differently, which is the really interesting and frankly exciting thing about our job, because we are so big on focusing on individual companies, individual sectors, not just broad market participation. And so I think there will be a difference in performance between these sectors and the underlying companies. So it's going to be fun to kind of dig through and see which ones are going to perform well, given the federal government policy that's going to drive things over the next administration. But I think just the general takeaways from this conversation is, I think the Trump administration is going to be pro-growth. Tax policy isn't going to change substantially, but it will probably lead to a net more take-home pay for the consumer. And then the big theme being deregulation, just easing up that federal oversight of business activity will probably be positive for the markets in the years to come.
And I think the big risk that people are looking at right now, kind of regardless of who won, but particularly under a Trump administration, is that deficit spending. And so it'll be really interesting to see if his tariffs as well as the growth plans, because there is economic growth to cutting taxes. And so we'll see if that growth side can outweigh some of the spending. And I'm just excited to watch what happens and provide updates as we go.
Definitely. Thanks, Hunter.
Thanks.